Let's talk about how the environment has changed. This is a good segue. We just went through a mass extinction event in 2023. We're in 2024 right now. And there are these cycles that happen. How would you explain these cycles of frothiness? And then right now in 2024, what would you be advising founders and how the funding environment has changed?
It's a catch-22, right? Because a lot of the massive funds chased deals to the register, right? The Tigers, the Sequoia, the Beyond. And the concept was, the deal is so damn big, we're going to get in at a pre-IPO level and write huge checks out of our fund, $300, $400, $500 million. And when it IPOs, we're going to be able to get liquidity and have another amazing placard on our wall. Well, that failed time and time again because there were so many tech IPO busts. So a lot of these VCs, I'll use like Andreessen, A16Z, are heavily dedicated to the seed and pre-seed round because you can go in, you can get an outsized amount of equity for limited dollars, right? You can put $3 million in or $2 million in and get 33% of the company. Well, a lot of those companies don't go on, but it's less dollars out potentially to ride with the company and continue to accumulate equity. Now, the catch-22 is there's a lot of money that's going into seed and pre-seed, right? Drive Capital in Columbus just created an $80 million seed, right? So there's more and more money going into it, but it makes it that much more competitive for seed and pre-seed, and the table stakes have gone up. So there's tons of cash on the sideline, albeit they're writing less checks, and we'll go into that in a second. You've got to be able to be a best-in-class deal within the pre-seed and seed environment. And Ed, you and I have seen some of these deals that have gotten funded, and they're fucking unbelievable. 7 years ago, they would have raised it a goofball valuation 5 years ago. But now they're just the best of what's out there, and they're able to successfully raise.
There's a flight to quality right now. Pedigree startups. Again, you mentioned earlier before, the barrier of entry has gone lower and lower, and therefore competition is high. There's way more demand for funding than there is supply. It's changing a lot. I remember back in the day, .com 1.0, Silicon Valley, Silicon Alley. I was a lot in Silicon Alley. People writing checks literally off the back of napkins. That was a thing that I've seen. Then the .com bubble burst in the late 2000s. I ended up with a lot of stock options of completely worthless companies. Go through it. Then Web 2.0 comes. People start to get into it, and they go, okay, it's not just about eyeballs. It's about actually creating revenue. Social media, Yahoo, becomes a thing. You see these things. Frothy, bubble starts to happen, and then it bursts again. And then we go through these different cycles, and right now we're in that stage where it's not about hyper growth anymore. It's not about let's just see the numbers. It's about, okay, we need growth, but we need a path to profitability as well. We actually need a solid business model. But in my mind, it'll start getting frothy again. Give it a few years as the IPO cycle starts to heat up. What's your prediction?
So it's an interesting question, and I have some friends that are managing partners at big VCs, what I would call macro VCs, in kind of their unified thought process. So you got to consider what is a VC, right? If you're talking about a big VC, you've got limited partners like a pension fund, okay, a $90 billion pension. They need to diversify. They can't buy all stocks and equity. They can't buy all real estate. So they create, 3% diversification into alternative investments. They get into VC. There's only so long that these LPs will be tolerant with the venture capitalists saying, hey, the market sucks right now. Deal flow sucks. We don't want to write any checks. You can only do that so long because it's dead money, right? That money's just sitting there. So from what I understand, the grace period of the LP saying, we get it, the market sucks, be cautious, is almost gone. So my friends have basically said the LPs are saying, you need to start writing checks. These investments have to start coming to fruition because our money's dead in your bank account where it could be in the equity market right now, which is making a run. So some of the bigger funds are getting probably appropriate pressure to open the checkbooks back up, maybe open the aperture back up and start writing checks again. They can't just sit on the money anymore. The job of a great venture capitalist is to be able to navigate all the ebbs and the flows in the macroeconomic environment and still make good investments. And that's their job. And while we were in a bad bearish market they still have to figure out, how can I make good investments to create a return for my LPs? That's my job. I think the tolerance is starting to wane a little bit, and more checks are being written because they're getting kind of some of that LP push.
Well, let's wrestle with this for a moment here. Back in the day, like I said, the crazy late 90s, literally angel investors were angels. They just wrote these checks. Like Peter Thiel writes the first check for Facebook back in the day, 500K,
Yep.
right? It was huge. It was massive. And there were investors that really want to see founders with a better than 0% chance do something, wanted to know. But then I think what happened was the machine of VC became so efficient and it became like a factory. And I've heard some of my fellow GPs and other people in the industry say VCs basically turned into an asset management game. These VCs aren't making money, and this might be the clash with the LPs. They're not making money from actually making investments and seeing exits. Very few VCs are actually getting liquid and capitalizing on that. Like Y Combinator, like great story, but the percentage of the amount of money that goes to the small group of VCs that are able to do it. So what do VCs do? They just raise funds and they charge a management fee. They charge their 2%.
Unbelievable.
And that's how they make money. So now they want founders to light capital on fire. That's what was happening a few years ago, just even like 3-4 years ago. Light my capital on fire and show the growth, so then I can take those numbers and raise another
100%
fund and make my 2%. I don't care if they go public or get acquired.
Yeah, it's the for VC partners, the get rich slow mechanism.
Yes, absolutely.
You know, $1 billion fund will pay $200 million in management over the course of 10 years.
That model has got to change in my mind if we're going to see healthier startups compared to what we had in 2021.
Well, it's an interesting thought. The blue bloods, so to speak, that have had astronomical returns are still turning money away in some cases from LPs, right? Everybody would want to get into the Sequoia's next fund. In some cases, maybe Excel's next fund. But there's only, to your point, there's only a handful of those. And VCs seem to be the last reckoning within massive asset managers, right? My brother runs a hedge fund. The 3%, 2.5%, 2% management fee days are fucking over. They're over, right? Maybe you can get a point for the same reason, where investors are saying, we want returns, we want returns. Hedge funds are different because they pay back every year. But VC, I do think there will be a level of a reckoning around the, put your feet up, go to Pete's Coffee and enjoy your life and collect that 2% time and time again. And they are incredibly strategic. It's so interesting that they can go raise another fund without liquidity, but on valuation, and say, hey, we just got these partners in, and we just raised an $800 million valuation. The LPs are like, that's a good signal. We're coming back in. You only have to do it a few times. I don't know if it's a full reckoning, but I do think things will continue to change, hopefully for the better within that environment. The other challenge is building a startup and getting to point of validation does cost some money, because all these marketing channels that were ghost towns before, think LinkedIn, are getting more and more expensive because everybody's using them. So now if you're a startup and you want to be able to show real growth and get to a positive ROAS, there's a substantial amount of dollars that need to be invested into those channels to find, the right audience and the right ads to be able to start to show some real trajectory. And you're competing against everybody. You're competing against my wife, right? As an entrepreneur who's also paying for ads. So I do think some of the cost per acquisition challenges are becoming very real, because everybody is paying for media now, and everybody is consuming media at orders of magnitude more than they were before, buying things off TikTok, buying things off Instagram. So VCs do have to come in and step in and put dollars in. I like the micro VCs, which are oftentimes exited founders, because they come in with a level of strategic guidance. Not to say that some of the big VCs don't, but there is still, I can't remember, somebody just sent it to me. There's still a crazy amount of cash on the sidelines that a lot of these big VC shops are continuing to hold. The other challenge, the economic challenge, is the too big to fail, but too big to succeed concept with some of the huge VCs. If you're a $5 billion fund, you know how hard it is to make a return? right? Seriously, like let's say you get 5% of $1 billion exit. That's $50 million in liquidity. And that just goes into your $5 billion, right? Your LPs don't get their return. You don't get your carry until that $5 billion threshold is met and there's additional profit above initial investment. Right now, it stages and waterfalls in different ways, but that's kind of the basics of it. So there is a bit of a too big to win concept out there as well.
I think that what will happen is same as other industries. You see this unbundling that occurs. It becomes centralized and then unbundled and then centralized again. I think that instead of just writing a check, VCs are going to have to offer more. They're going to say, all right, you know what, you actually don't need money right now. You need acceleration to product market fit, or you need to figure out how to scale, or you need recruiting that's happening at this point in time. We're going to do that. And I almost think that I remember sweat equity ventures. That was a fascinating model that I was studying. I think that's going to become a lot more common. And they're going to look at the YCs and say, okay, Y Combinator did it at the pre-seed seed level. Why can't we do it at a later stage? Those are some of my thoughts.
I liked the BDev Ventures model in San Fran where they would pay for your pilot, right? They were incredibly good at email-based B2B acquisition for small ticket enterprise. So you would come in and they would basically run a 3-month pilot. You kept all the sales to start to validate the ability to expand this thing into market, right? Because founders didn't necessarily have the cash or the know-how to be able to scale acquisition in that way. So I do agree that some of the VCs will be able to create a competitive advantage by having some of those capabilities in-house. Now, the reality is, though, Ed, the big blue bloods are still getting, it's still everybody's dream spot for a founder to land. So they're not in a desperate point where they should or could insert some of those capabilities. Sequoia is going to get the best founders in the world sending their decks because of their long track record. Ohio State's going to get the best football recruits because of their long storied track record, right? I mean, it's just, it's the reality.
True.
But they only invest in a handful of companies. So, what happens to the rest of the founders that are out there that need some form of capital?